Many investors rely on cash-on-cash return as their main decision-making tool. But is that a good idea? I discussed this question in 2 of my lessons in my course on real estate investment analysis. And I invite you to watch this second brief excerpt now. Hope you find it interesting. And as always, I hope to see you in class. If you buy a property, a rental property, you probably expect to hold it for several years, operate it, enjoy some cash flow from it, and then ultimately resell it for a profit. So in that scenario, there are a lot more things going on than just the first-year cash flow. If you look simply at the property's first-year performance, then you're not taking into account anything having to do with its future performance. And of course, the ultimate resale may be a very important part of that future performance. Okay, you say then, I think what I'll do is I'll estimate the cash-on-cash return for each of the next several years. That sounds like a reasonable retort to my complaint, right? Well, although that might look like a step in the right direction, but the problem with that approach is that it fails to take into account the time value of money. If you look at, for example, the cash flow that you anticipate in year 2 or year 3 or 5 or year 10, and then weigh that against the cash investment, you are weighing the face value of some future cash flow, undiscounted, against the face value of your present-day cash investment. There's a time value to money, and that money that you receive in the future is less valuable than money you receive today. You've got to discount the value of the money that you're going to get in the future. Certainly you need to discount it if you're going to compare it to money that you're spending today. So for example, if you were looking at this same $10,400 cash flow in year 5, would it make sense to measure it against the $100,000 investment that you're committing today? Well, it probably would not.